Okay, let's unpack this. Have you ever stared at investment options, feeling like you need I don't know, a financial dictionary just to decipher where to put your hard-earned money?
Oh, absolutely. It happens all the time.
Like the entire world of investing is spoken in some ancient, arcane language, designed to keep the common person, dare I say, the plebe of the modern financial world, utterly bewildered.
It can certainly feel that way. There's so much jargon.
Well, today we're cutting through all that noise. We want to simplify one of the biggest investment decisions you'll probably ever face.
A really fundamental one.
We're talking about exchange-traded funds, or ETFs, versus mutual funds. Now, these aren't just obscure financial products, they are absolute titans of the investment world.
Huge. Just massive in scale.
Yeah, I mean, in the US alone, Americans have over $30 trillion invested in these two vehicles combined.
30 trillion.
Mm.
It's staggering.
That makes them foundational cornerstones of financial planning for literally millions of people, from folks just starting out to, seasoned retirees.
And for very good reason. They serve a vital purpose.
Right. Both are ingeniously designed to pool money from a multitude of different investors. The big, beautiful idea here is to give you instant diversification.
That's the key word right there, diversification.
It allows even modest investments to own tiny, tiny pieces of hundreds or even thousands of different stocks, bonds, or other securities.
Mm-hmm.
Think about it. You don't have to go out and painstakingly pick every single stock or bond yourself, which, let's be honest, would be a full-time job in itself, and then some.
Exactly. It saves immense time and effort.
So our mission today is to give you the ultimate shortcut to understanding these investment cousins. We call it Plebonomics.
I like that. Plebonomics.
Yeah, it's our approach to simplifying complex financial choices for the everyday investor, helping you feel empowered and informed rather than just, drowning in an ocean of jargon.
Making it accessible.
By the end of this deep dive, we want you to walk away with a crystal clear sense of what these are, how they work, and, most importantly, which one might be the best fit for your unique financial journey.
And what's truly fascinating here is that while ETFs and mutual funds perform a very similar basic function, the subtle nuances in their structure and operation can profoundly impact your investment journey.
Right, the details matter.
They really do. So we're going to connect those dots for you, explaining not just what the differences are, but more importantly, why those distinctions matter to you, the individual investor looking to build a secure financial future.
Okay, where do we start?
Well, we'll start by exploring their shared DNA, the fundamental characteristics that make them investment cousins.
Makes sense.
Then we'll pivot to the key differences, the points where their paths truly diverge.
And finally,
We'll offer you a practical, straightforward guide to help you decide which one, or perhaps even a combination, might be the right choice for you.
perfect. So let's kick off with segment one. The shared DNA, how ETFs and mutual funds are investment cousins. First up, their core concept, pooled investments and diversification. You said it's key.
Indeed, it's the foundation. At their very heart, both exchange-traded funds and mutual funds operate by collecting money from a large number of investors.
Pooling it all together.
Exactly. And this isn't merely about convenience. It's a fundamental principle of effective financial strategy. This pooled money is then strategically used to buy a diverse mix of stocks, bonds, or other investments.
A whole basket of stuff.
Right. What this truly means for you, the individual investor, is that you get exposure to hundreds, sometimes even thousands, of different investments.
Wow.
You achieve this even if you only have a modest amount of money to start with, say, a few $100s or even less. It's an incredibly efficient way to gain broad market exposure.
It's like getting a pre-assembled, expertly curated basket of diverse goodies, rather than having to painstakingly gather each individual item yourself.
That's a great analogy.
Imagine for a moment trying to buy a tiny slice of every company in the S&P 500, that's the Standard & Poor's 500, a stock market index representing 500 of the largest U.S. companies. Doing that on your own would be virtually impossible, both practically and financially.
Forget about it.
But with these funds, you get that instant diversification without needing to pick every individual security. It significantly reduces the complexity, the time commitment, and the financial barrier for you to build a robust portfolio.
And, if we connect this to the bigger picture, diversification is a core, non-negotiable principle of risk management and investing.
Don't put all your eggs in one basket.
Pretty much. It's about spreading your investments across various asset classes, industries, and geographies to reduce the impact of any single asset or sector performing poorly.
So if one thing goes down.
Its negative effect on your overall portfolio is mitigated because other investments might be performing well. Both ETFs and mutual funds inherently provide this diversified exposure, significantly reducing what's known as individual asset risk.
Which sounds important.
It's absolutely crucial for protecting your hard-earned savings and fostering long-term wealth accumulation.
Okay, so pooling money for diversification is number one. What else do they share?
Professional management.
Ah, so someone's actually steering the ship.
Precisely. These aren't just random collections of assets tossed together. Instead, they are diligently managed by financial experts who meticulously select and oversee the fund's holdings according to precise guidelines.
Where do you find those guidelines?
They're outlined in the fund's prospectus. That prospectus is basically the fund's rule book, detailing its investment objectives, its strategies, and, importantly, its risks.
Gotcha.
This professional oversight saves you, the individual investor, an immense amount of time and effort. You don't need to become a market guru overnight, trying to decipher complex financial data or track thousands of companies yourself.
That's a huge relief for most people, I imagine.
It really is. These professional managers are constantly monitoring market conditions, economic trends, and the performance of the fund's underlying assets, making adjustments as needed.
But there are different types of managers, right?
Yes, that's an important distinction. Some fund managers, particularly those overseeing index funds, are simply tracking a specific market index, like the S&P 500. Their goal is just to mimic its performance as closely as possible.
So, more passive.
Right, requiring less active decision-making. Others, especially with actively managed funds, are engaged in intensive research and strategic decision-making. They're actively picking individual investments with the aim of beating the market's performance.
Trying to find those winners.
Exactly. They're trying to find those hidden gems, capitalize on mispricings, or anticipate major market shifts.
And that's different from, say, my personal financial advisor.
Very different. A fund manager oversees the specific assets within a particular fund. A financial advisor provides tailored, comprehensive advice, looking at your whole financial picture, your goals, risk tolerance, tax situation, everything to help you build a holistic plan, which might include various funds.
Okay, that clarifies things. What other shared traits?
Regulatory oversight and investor protection. This offers tremendous peace of mind.
So there are rules.
Lots of rules. In the U.S., both ETFs and mutual funds are rigorously regulated by authorities like the SEC, the Securities and Exchange Commission.
Not the Wild West, then.
Far from it. These funds must adhere to specific legal and financial reporting standards, which are designed to ensure transparency, fairness, and ultimately, investor protection. Think of the Investment Company Act of 1940. It's a landmark law governing these types of pooled investments.
What does that mean practically for me, the investor?
It means funds must regularly disclose their financial condition, their investment strategies, and their fees. This transparency allows you to make informed decisions and have greater confidence that your investments are being handled according to established regulations. It minimizes the risk of fraud or mismanagement.
Good to know there's a safety net.
It's a foundational element, absolutely.
Hmm.
Contributes to the integrity of the whole market.
Okay, and what about getting my money out if I need it?
That brings us to liquidity and accessibility. Both offer commendable flexibility here.
Meaning,
Both types of funds allow for relatively easy access to capital. And crucially, they offer affordable access to diversified portfolios compared with buying individual stocks or bonds.
so you're not locking your money away forever in some inaccessible vault?
Generally, no.
You can get to your capital when you need it, and you certainly don't need to be a millionaire to get started.
Not at all. You can often begin investing with a fairly modest sum for some funds, literally just a few dollars.
That's a monumental win for the everyday person, right? Just getting into the market.
Absolutely. Most stock and bond trades typically settle in 2 business days. That's
Right.
T+2 settlement. So the cash from your sale is usually available very quickly.
That affordability is a real game changer then.
It really democratizes investing. It allows a much broader spectrum of individuals to participate in market growth without needing substantial upfront capital. This ease of access, combined with the professional management and diversification, makes both incredibly powerful tools.
Okay, one more similarity.
Yes, the sheer variety of investment options available across both categories is truly staggering.
Like what kind of variety?
Well, you can find funds that invest broadly, like total market funds that replicate entire U.S. or international stock and bond indexes.
So owning a piece of everything, basically.
Pretty much. Fantastic for getting comprehensive market exposure with minimal effort. But you can also go much more narrowly if you have a specific conviction or area of interest.
Like what? Specific industries.
Exactly. You might find funds specializing in high dividend stocks
Yeah.
designed for income. Or there are sector funds focusing on specific industries like healthcare, real estate, biotech, medical devices, energy, technology, you name it.
So you can target areas you believe in.
You can. But remember, that also concentrates your risk compared to a broad market fund. Less diversification across sectors.
Makes sense. And it's not just stocks.
No, they span all sorts of asset classes. Whether you're interested in equities, stocks, bonds, fixed income, commodities like gold or oil, real estate, or even a strategic mix of all these, there's almost certainly an ETF or mutual fund designed for that.
Wow. So you can really tailor your strategy.
Genuinely. To almost any goal, any interest, any risk tolerance, very adaptable.
Okay. So we've seen their shared roots, the deep foundational similarities that make them investment cousins, strong family resemblance.
Definitely.
But now, here's where it gets really interesting. While they share that purpose, the nuanced details of their structure and daily operation are where their paths diverge significantly.
And this is crucial.
For you, the everyday investor, understanding these distinctions is absolutely critical because they can have a tangible impact on your investment experience, your costs, and even your tax bill.
That's a crucial point. And it immediately raises that question. If they do such a similar basic thing, why do we have both?
Yeah, why both?
The answer truly lies in their structural differences
Yeah.
and how they operate day to day. These distinctions carry significant implications for you regarding trading flexibility, management approach, costs, tax efficiency,
All the important stuff.
pretty much.
Yeah.
Let's delve into these core distinctions now, because grasping them is key to making truly informed decisions for your financial future.
All right, let's do it. Difference number one.
Trading flexibility and timing. It's a big one. Let's start with ETFs.
Exchange-traded funds. The name gives a clue.
It does. They are exchange-traded. This means they trade on major stock exchanges throughout the day, just like individual company stocks, think Apple or Microsoft.
So prices change constantly.
All day long. This allows for real-time pricing. When you decide to buy or sell an ETF, that transaction happens at the prevailing market price at that exact moment.
Instant feedback.
Pretty much. You can buy and sell them continuously from market open to market close through any brokerage account. This makes them incredibly flexible.
So if you're the type of investor who likes to keep an eye on the market, maybe react to breaking news or make strategic moves quickly during the day,
ETFs offer that real-time control and responsiveness. You can react immediately to short-term trends and shifts.
and you mentioned different ways to buy or sell.
Yes, you can utilize a range of sophisticated order types that aren't available with traditional mutual funds.
Right.
It's not just buy now or sell now.
Like what?
Well, you have basic market orders for immediate execution at the best available price.
Yeah.
But you also have precision tools, like limit orders, where you specify the maximum price you'll pay to buy or the minimum price you'll accept to sell.
So you don't overpay or undersell.
Exactly. Then there are stop orders, which trigger a sale or buy if the price hits a certain point, often used to minimize potential losses. And stop limit orders offer even more granular control.
Wow. Lots of levers to pull if you want them.
If you choose to use them, yes. Very powerful for active traders.
Okay, so that's ETFs. How do mutual funds differ here?
Quite distinctly. Their trades happen once daily after the market closes.
Only once.
Only once. You can place an order anytime during the trading day, 9 a.m., 3 p.m., doesn't matter. But it won't actually execute until the market officially closes, usually 4 p.m. Eastern Time.
And the price.
The price you get is based on the fund's net asset value, or NAV. The NAV is calculated at the end of each trading day. It's the total value of everything the fund owns minus liabilities divided by the number of shares, a snapshot.
So if I buy at 10 a.m. and someone else buys at 2 p.m.,
You'll get the same price as everyone else who bought and sold that day before the market closed. You won't know the exact price until after 4 p.m.
no intraday action then.
Nope. This end-of-day pricing means no opportunity for intraday trading, no reacting to minute-by-minute moves, but it also simplifies things for those who prefer a more hands-off, long-term approach.
Less checking your phone all day.
Exactly. You don't need to worry about timing the market perfectly during the day. Everyone gets the same calculated price. It's less about market timing, more about consistent long-term investing.
Okay, difference one, trading. What's next?
Difference two, management style. This really impacts performance and costs.
Active versus passive. Right.
Broadly, yes. The vast majority of ETFs are primarily passively managed. Their aim is to mirror the ups and downs of specific market indexes, like the S&P 500.
Just track the market.
Right. Their goal isn't to beat the market, just track it closely. They invest in the same stuff, in the same proportions as the index. Relies on the market being efficient overall.
But not all ETFs are passive.
No. While most are, actively managed ETFs are becoming increasingly available, especially in niche areas. They offer that active approach, but within the ETF structure.
Yeah, and mutual funds.
They are more commonly actively managed. This is where you have professional managers, often with big research teams, actively picking investments, trying to beat the market's performance, or strategically shift fund assets.
Doing that deep dive research.
Exactly. Looking into companies, forecasting the economy, making strategic buys and sells to try and outperform a benchmark.
But mutual funds can be passive, too.
Yes, absolutely. Some mutual funds also track indexes, just like passive ETFs. We call them index mutual funds. So you have passive options in both structures.
What are the implications of active versus passive management, mainly cost?
Cost is a huge one. Active management typically incurs higher costs. Think about it. You're paying for skilled analysts, extensive research, company visits, administrative overhead, all that effort to try and beat the market.
Right, someone's got to pay for that.
Whereas passive funds are generally cheaper. They require far less hands-on management. They're just following a recipe of the index. That cuts down operational expenses significantly.
This seems like a good place to talk about target date funds. They seem like a special case.
They are, and they're predominantly mutual funds. They offer a fantastic set-it-and-forget-it appeal, especially for long-term goals like retirement in, say, a 401k.
How do they work?
They're cleverly designed. They automatically adjust their mix of stocks and bonds, becoming more conservative over time as the target retirement year approaches.
So they change as I get older.
Automatically. Let's say you invest in a target date 2050 fund. When you're young, decades from 2050, it holds more stocks for growth. Potential higher risk, too. As you get closer to 2050, the fund gradually, automatically shifts towards more conservative stuff, like bonds, more stability, less volatility, aiming to protect your savings as you near retirement.
What's that shift called?
It's called the fund's glide path.
Glide path. Like landing a plane.
Kind of. Think of it as a self-driving car for your retirement savings. Goes faster for growth when the destination is far away, automatically slows down and gets more cautious as you get closer.
Taking the rebalancing off my shoulders.
It's exactly. Financial autopilot. That's why they're especially popular in workplace retirement plans, where they're often the default investment choice.
Makes sense for people who don't want to actively manage.
Precisely. Employers like them for that reason. Easy, diversified. Now, while most are mutual funds, target date ETFs do exist, just less common.
Okay, crucial difference number 3. Cost and fees. This is where it hits the wallet.
Definitely. We all want to keep more of our money working for us. Fees, even small ones, really add up over time because of compounding.
So the general rule.
The general principle is that ETFs typically charge lower fees, while mutual funds often have higher expense ratios, especially actively managed funds, mostly due to that active versus passive difference.
No, you said mutual fund fees have come down.
They have, significantly for index mutual funds, thanks to competition. But the general tendency still holds.
Okay, define expense ratio. Crucial term.
It is. It's the total annual operating expense, expressed as a percentage of your investment. You pay it every year, regardless of performance. Covers management fees, admin costs, maybe marketing.
So it comes right out of my return.
Directly.
Okay.
To give you some concrete numbers from 2023, the average fund cost for actively managed funds was about 1.01%. Passively managed funds average 0.55%.
Big difference.
Huge. Looking at medians, SPDR ETFs were around 0.52%, while mutual funds were 0.91%.
Even within the same company.
Even then, look at Vanguard. Their S&P 500 ETF, VOO, is 0.03%. Their equivalent index mutual fund, VFIAX, is 0.04%.
That's only a 0.01% difference. Seems tiny.
Seems tiny, but it's important to understand that even small differences in expense ratios can add up significantly over long investment horizons. That 0.01% compounded over 20, 30, 40 years. It can mean tens of thousands of dollars less in your pocket.
Wow. Okay, point taken. Are there other fees besides the expense ratio?
Yes, especially with mutual funds historically. You might encounter load fees, which are sales charges. Yeah, front-end loads are deducted when you buy. Back-end loads, or deferred sales charges, hit you when you sell. Maybe if you sell too soon, like within a few years, often called early withdrawal penalties.
Can I avoid those?
Yes, look for no-load funds.
Yeah.
They don't have these sales charges and are popular with self-directed investors.
Any other mutual fund fees?
Well, historically, some had trailing commissions paid to advisors, though that's less common now for direct investors in places like Canada. And then there are 12b1 fees in the U.S.
What are those?
Annual fees, usually small, used for marketing, distribution, shareholder services. These 12b1 fees are a primary operational difference. ETFs generally don't have them.
Okay, what about extra ETF fees? They sound cheaper overall.
Lower expense ratios, generally yes, but they can have additional fees related to trading. You might pay brokerage fees or trading commissions each time you buy or sell.
Why?
Yeah, because many big brokers now offer commission-free ETF trading programs. You definitely need to check your broker's specific fee schedule before trading.
Good tip. Anything else unique to ETF costs?
Yes, the spread. That's the difference between the buying price, the ask, and the selling price, the bid.
Like buying currency at the airport.
Kind of like that, yeah. There's always a small gap. It's a built-in cost for every trade. The larger the spread, the larger the cost. There's no way to get around this.
And another potential cost.
ETFs can sometimes trade at slight premiums and discounts to NAV. Unlike mutual funds always priced at NAV end of day, an ETF's market price might drift slightly above or below its underlying value during the day.
Is that common?
Usually it's very small and quickly corrected by market makers. But if you happen to buy at a premium and sell at a discount, especially with frequent trades or less liquid ETFs, that can be a costly delay or drag on returns. Mutual funds avoid this by always trading at NAV.
So it's not just the expense ratio.
Exactly. You need to think about the total cost of ownership, or TCO. For ETFs, it's expense ratio plus commissions, spreads, maybe premium discount effects. For mutual funds, it's expense ratio plus any loads or 12b1 fees. Look at the whole picture.
Okay, vital stuff. Let's move to difference number 4. Tax efficiency. Sounds dry, but maybe important.
Extremely important. It can genuinely save you, the everyday investor, a substantial amount of money over time, especially in taxable accounts.
How does tax law view them?
The core principle is that tax law generally treats capital gains, capital losses, and dividends the same for both. Qualified dividends get lower rates, for example.
So what's the difference then?
It's how those gains are triggered and distributed to you, the investor.
Yeah.
And that differs significantly because of their structures.
And ETFs have an edge here.
A big one. They're often more tax efficient because of their unique structure, specifically the in-kind creation and redemption processes.
In kind, what's that?
Okay, simply put, when big money moves in or out of an ETF, the ETF manager can exchange large baskets of the actual underlying stocks directly with a special firm, an authorized participant, instead of selling stocks for cash inside the fund.
And why does that matter?
Because selling stocks inside the fund triggers taxable capital gains for all shareholders. This in-kind swap avoids that internal selling, minimizing those taxable events within the fund itself.
Dodging the tax trigger.
Precisely. Also, when you sell your ETF shares, you're usually selling to another investor on the stock exchange. The fund itself usually isn't involved and doesn't have to sell any securities, potentially triggering capital gains.
So I only pay tax when I sell.
Generally, yes. Investors generally only pay capital gains tax after they sell their shares, giving you direct control over the timing of those taxes. You decide when to realize the gain.
It's like the ETF has a built-in advantage for avoiding those annual tax surprises. I control when I potentially owe tax by deciding when to sell.
That's a great way to put it. That control is invaluable for managing your tax bill.
How do mutual funds compare on taxes?
They tend to have higher tax implications. Their structure often forces taxable events. Buying or selling by the fund manager within the fund's portfolio can trigger capital gains that are passed on to investors.
Even if I didn't sell my shares?
Even if you just held on. This happens because managers have to rebalance or manage cash flows as investors buy or sell directly from the fund. This constant change in the portfolio can create taxable events for shareholders.
So I might get a tax bill just for holding.
Correct. Mutual funds will distribute taxable gains to investors even if they merely hold the shares. You could owe taxes at year-end without having sold anything yourself.
That sounds annoying.
It can be. This fundamental difference leads to a very common practical application. Mutual funds are often held in tax-advantaged accounts like IRAs and 401ks.
Why there?
Because inside those accounts, Those annual capital gains distributions aren't taxed until you withdraw in retirement. The tax is deferred or potentially eliminated if it's a Roth account.
And ETFs.
They are often held in taxable accounts, such as standard brokerage accounts, precisely because they're more tax efficient. Investors can better control and defer realizing gains until they choose to sell.
Did the numbers back this up?
Dramatically. In 2023, only 2.5% of all ETFs distributed capital gains. Compare that to 31.5% of mutual funds.
Wow, 2.5% versus over 30%.
Massive difference. Nearly a third of mutual fund investors got a taxable distribution just for holding, much less likely with an ETF.
Okay, tax efficiency. Big win for ETFs and taxable accounts. Difference number 5.
Minimum investment requirements. This is significant for folks starting out or investing smaller amounts regularly.
How do ETFs stack up?
Very accessible. Generally, no minimum investment beyond the price of one share or unit.
So if a share costs $50, I just need $50.
Pretty much. And many brokers now allow fractional shares, so you could potentially buy a Vanguard ETF for as little as $1. This makes them incredibly accessible to a broader range of investors.
Great for putting in small amounts regularly.
Fantastic for that. Say $50 every payday. ETFs make that easy.
And mutual funds.
They often require a minimum initial investment. This can range from a few hundred to several $1,000s. For example, that Vanguard 500 Index Admiral Shares Fund we mentioned, $3,000 minimum initial investment.
$3,000 just to start. That's a hurdle.
It can be, absolutely. Once you're in, you can usually add smaller amounts. But that initial requirement can block new investors.
But mutual funds allow fractional shares too, right?
Yes. Once you meet the minimum, they're great for investing exact dollar amounts, like $100 a month. Every penny goes in. But ETFs, especially with fractional shares becoming common at brokers, often have a much lower entry barrier.
Got it. Lower hurdle for ETFs. Okay, 6th and final core difference.
Transparency of holdings. How much do you know about what's actually inside the fund?
Is there a difference?
A significant one.
Yeah.
ETFs disclose their holdings on a daily basis.
Every day.
Every single day. This gives you an up-to-date, fully transparent view of their investments. You can go online and see exactly what stocks or bonds it owns right now.
Real-time insight.
Exactly. Major advantage if you want to monitor closely or understand your precise exposures.
And mutual funds.
They normally release their holdings on a quarterly basis, often with a 30-day lag.
Quarterly. So the info could be months old.
Could be up to 4 months old, yeah.
Hmm.
The information investors see may not always be up to date. If knowing exactly what you own right now is important, ETFs offer much greater immediacy.
Okay. Daily versus quarterly transparency. Any other quick nuances?
Just briefly, both are generally open-ended funds, meaning shares adjust to demand, keeping price near underlying value. This differs from closed-end funds, which have a fixed number of shares and can trade at big premiums or discounts.
Okay.
And, just showing how the ETF structure evolves, spot Bitcoin ETFs were approved in 2024, bringing crypto into this regulated, accessible format.
Interesting. Okay, sure. We've covered a lot of ground. Shared DNA, then the big differences. Trading, management, cost, tax, minimums, transparency.
Cover the key points.
Now, the big question for your money, listening out there. What does this all mean for you? The choice isn't about one being inherently better in some objective sense, is it?
Not at all. It's truly about finding the best fit for your goals, your comfort level, and your unique investment style. We've given you the info. Now let's help apply it with our Plebonomics decision guide.
Right, applying the knowledge.
And remember, this isn't an eater's decision forcing you into one box.
Yeah.
Mutual funds and ETFs can live perfectly happily side by side in a well-diversified portfolio. Many savvy investors use both.
Good point. Mix and match is okay.
Absolutely. The crucial first step for you is to understand your unique investor profile objectives, time horizon, preferences for hands-on versus automation.
Okay, let's break it down then. Consider an ETF if you. What's the first reason?
First, you want lower costs and tax efficiency. ETFs appeal strongly to cost-conscious investors, lower expense ratios, especially for passive ETFs, and that inherent tax efficiency from the in-kind structure.
Fewer surprise tax bills in taxable accounts.
It's exactly. Fewer capital gains distributions passed on annually. You control the timing of gains realization when you sell. Significant tax advantage.
Okay. Reason 2 to consider an ETF.
You prefer trading flexibility and control. If you trade actively or just want the option to react to market moves intraday, ETFs are your vehicle.
Using those sophisticated orders.
Right. Stop orders, limit orders, maybe options or short selling if that's your strategy. Plus, you get that real-time pricing and immediate transaction confirmation. puts tactical control in your hands.
Me in three.
You have a smaller budget for initial investment. Since there's often no minimum beyond one share price, ETFs are incredibly accessible to investors with smaller amounts to invest.
Get started with just a few bucks, potentially.
Potentially, yes, with fractional shares. A fantastic low-barrier entry point for new investors or those making consistent smaller contributions.
And the fourth reason for an ETF.
You value transparency. If you like knowing exactly what's in your investment basket every single day, no lag, ETFs provide that daily disclosure of holdings. Full visibility.
Okay, that's a strong case for ETFs for certain investors. Now, flip side. Consider a mutual fund, especially an index or target date fund if you. Reason one.
You prefer automated regular investing. Mutual funds excel at dollar-cost averaging, investing a set amount regularly. They allow purchasing fractional shares down to the penny, so every dollar goes to work immediately.
Perfect for autopilot investing.
Exactly. They are easily incorporated into a set-it-and-forget-it automatic contribution program, like in a 401k.
If you like setting things up to run automatically, mutual funds, especially target date ones, are incredibly smooth. Set up contributions, fund does the rest, including rebalancing for target date funds, low maintenance wealth building.
Very true. Second reason for a mutual fund. You desire professional active management.
If you believe a manager can beat the market.
Right. If you're looking for funds that could potentially outperform the benchmark index, or you value the specialized knowledge of a manager, actively managed mutual funds are designed for that.
Especially in certain markets.
Yes, potentially more valuable in less efficient markets, like high-yield bonds, small-cap stocks, emerging markets where deep research might add real value. Also good if you prefer a hands-off way yourself and work with an advisor who utilizes them.
Okay, reason three for mutual funds.
You are investing for long-term goals. Their structure, sometimes with higher minimums or past redemption fees, further encourages investors to stay invested even during challenging market conditions. Built for the long haul.
Discourages knee-jerk selling.
Exactly. Aligns well with a patient, long-term philosophy.
And the fourth reason.
You're concerned about bid-ask spreads or thinly traded funds. Because mutual funds always trade at NAV end of day, you avoid potential price discrepancies or wider spreads sometimes seen in less liquid ETFs.
Guaranteed fair value at close.
Precisely. Removes that layer of trading complexity and potential implicit cost ETFs might have, especially for niche funds.
Okay, those are great guides. But some things apply to both, right?
Absolutely. Some important considerations for both. First, diversification. Both inherently offer it, reducing your risk.
Crucial point. Second.
Risk. Remember, the risk of a fund depends entirely on its underlying holdings, not the structure. A stock fund is riskier than a bond fund, whether it's an ETF or a mutual fund.
Don't assume ETF means low risk or mutual fund means high risk. Look inside.
Exactly. Look at what it holds. And third,
Getting help.
yes. If you feel overwhelmed, remember, professional help is available. A qualified financial professional can help you build a portfolio that will help you achieve your goals, considering your whole situation. Don't go it alone if you're unsure.
Great advice. So wrapping that up.
To reiterate that balance point, both ETFs and mutual funds are durable and valuable tools for investors building a diversified investment portfolio. And, as we've said, many investors wisely build their portfolios with a combination of the two.
Understand what each offers and how it fits you.
That's the key.
We've taken a deep dive into the fascinating world of exchange-traded funds and mutual funds today, really tried to strip away the complexity, reveal the core truths about these incredibly powerful investment tools.
Covered a lot of ground.
Our goal was to provide you, the everyday person, with the Plebonomics shortcut, that clear, actionable knowledge to feel confident about these crucial choices. We explored their shared strengths, their distinct differences, trading dynamics, management styles, costs, taxes, minimums, transparency.
All the critical factors. And the ultimate takeaway from this deep dive is that knowledge is most valuable when it's not just understood, but truly applied.
Right, putting it into practice.
By grasping these distinctions between ETFs and mutual funds, you're not just informed, you're profoundly empowered to make choices that genuinely align with your financial future. Whether you prefer that daily ebb and flow of ETF trading or the serene set-it-and-forget-it strategy often found with mutual funds, you now have the insights to choose wisely.
So what's the next step for the listener?
The next step is to objectively evaluate your own investment style, your unique goals, your personal time horizon, and your comfort with risk. Be honest with yourself.
So, as you step forward into your financial journey, armed with this deeper understanding, ask yourself, what kind of investor are you? And how will this understanding help you build the financial foundation you truly deserve?
A powerful question to consider.
We hope this deep dive has armed you with precisely the insights you need to make those empowered decisions.